Microsoft's capital expenditure has exploded from $20.6 billion to $97.2 billion in just 4 years. Free cash flow, meanwhile, has flatlined near $73 billion. The data center buildout is swallowing almost everything the software business earns, and the stock now sits near the bottom of its range. So here is the question that decides everything. Can a build-out this enormous be earned back at the returns the old, richer multiple quietly assumed? Or is a proven software compounder turning into a capital-hungry infrastructure business the market no longer wants to pay up for? By the end, you will understand what Microsoft has become, how its cash is now spent, where its moat still holds, and whether a stock down almost 24% over the past year is cheap, barely valued, or still asking too much. Microsoft sells the software and cloud that runs most of corporate computing. Office and Microsoft 365, the Azure cloud platform, Windows, LinkedIn, Dynamics business applications, and Xbox gaming. Trailing revenue of $318 billion, net income of $125 billion. This is a giant. 2 enterprise franchises anchor everything. Server products and cloud services, the home of Azure, is the largest at $98.4 billion. Microsoft 365 commercial follows at $87.8 billion. Together, 2/3 of all sales, recurring and sold straight into corporate technology budgets. The rest is a long tail: gaming, LinkedIn, Windows, search advertising, each meaningful, none large enough to move the needle. That means the valuation lives and dies on one line: commercial cloud. A stumble in Azure is not a segment problem, it is the whole thesis. The top line is the easy part of this story. Revenue compounded at roughly 13.8% a year, from $168 billion in fiscal 2021 to $282 billion in 2025. The trailing figure of $318 billion shows the pace has, if anything, quickened. Earnings grew even faster. Diluted earnings per share climbed from $8.05 to $13.64, and the trailing figure is $16.80. Earnings outrunning revenue is the fingerprint of operating leverage. Incremental cloud revenue drops through at a high margin. The margins are genuinely impressive. Gross margin has sat near 68 to 70% for 5 straight years, even as Azure grew into a $98 billion business. Operating margin actually expanded from 41.6% to over 45%. No margin compression on the income statement yet. Returns on capital tell the subtler story beneath the sell-off. Return on invested capital was 23.5% in 2021. It has drifted down every year since to 21% trailing. Still more than double the cost of capital, but the direction matters. Here is what changed. Capital expenditure was $20 billion in 2021. Trailing, it is $97.2 billion. The property base has more than quadrupled to $308 billion. Microsoft is pouring capital into the ground faster than any software company ever has. And that is why free cash flow has stalled. $74 billion in 2024, $72 in 2025, $73 trailing, dead flat for 3 years, while net income rose more than 40%. A software compounder has become an infrastructure builder whose cash is capped by its own reinvestment appetite. The cash flow statement now reads like a hyperscaler's. Trailing capital expenditure of $97 billion dwarfs every other use. Against that, $26 billion in dividends and $22 billion in buybacks. Capital that once flowed to shareholders now flows into Azure regions. The dividend is treated as sacrosanct. The per-share payout grew from $2.19 in 2021 to a trailing rate of $3.56, roughly 10% a year. It absorbs only about 21% of net income, so it is very safe, but the yield is thin, under 1%. Buybacks tell the more revealing story. Repurchases of $22 billion barely outrun stock-based compensation. The diluted share count has fallen under 2% in 5 years. just enough to offset dilution. This is no longer the aggressive per-share lever it once was. Microsoft owns one of the widest moats in the market. Switching costs are enormous. Enterprises running identity, email, and documents on Microsoft 365 face wrenching disruption to leave. 5 years of returns above 20% are the fingerprint of durable pricing power. The Moat has one weak spot. Return on equity has slid from 43% in 2021 to around 33% trailing, as the invested base swells faster than profit. This is not competitive decay. The new infrastructure capital simply earns less than the legacy software it was built on. Still ahead, whether this stock is actually cheap and the one risk that could break the case. But the backdrop matters first. Rates are staying higher for longer, cuts priced out. For a company whose payoff arrives years out, a rising discount rate compresses exactly those distant cash flows. The whole sector sits in the maximal spending phase of the AI infrastructure cycle. Combined hyperscaler capital spending is running toward roughly $700 billion for 2026, with Microsoft's own program guided near $190 billion. Cash out fast, returns lagging by years. Sentiment has swung from euphoria to show me. The stock has fallen nearly 24% over the past year and trades about 29% below its 52-week high, near the low of its range, the worst drawdown since the dot-com era. Azure grew about 40% in the latest print, with AI recurring revenue past $37 billion, up 123%. Real evidence the buildout generates revenue. The concrete catalyst is dated. Fiscal fourth quarter earnings on July 29th show whether Azure holds that growth. All of that quality has a price. The core valuation asks what the spending buys. Assume revenue keeps compounding in the mid-teens, margins hold in the mid-40s, and capital intensity eventually falls back toward 18 to 22% of revenue as the build-out matures. Under those assumptions, normalized free cash flow by the end of the decade plausibly reaches $150 to $180 billion. Discounted at 9% with a 4% terminal growth rate, the discounted cash flow model gives fair value of roughly $410 to $520 per share. Wall Street's numbers give a useful check. Consensus sees earnings per share of $16.80 this year, $19.44 next, and $22.77 in 2028, about 16% compounded, on revenue reaching $456 billion. Today's price pays under 20 times earnings 2 years out for that growth. A multiples lens agrees. The stock trades at 14.7 times enterprise value to EBITDA, against a 5-year average above 20. Even a conservative 16 to 19 times gives roughly $419 to $500 a share, though this lens ignores the very capex under debate. Blend the three lenses, discounted cash flow weighted most heavily, then consensus earnings, then the multiples check, and fair value lands around $420 to $530. Against today's $385, the stock trades below every model, midpoint near $475. The dominant risk is that the build-out over-earns today and under-earns tomorrow. Depreciation from new data centers, already $43.6 billion and rising fast, hits earnings while revenue arrives more slowly than promised. The tell would be Azure decelerating into the 20s while Capex stays elevated. A quieter obligation is building too. Capital and finance leases have climbed from $24 billion in 2021 to $85 billion, as Microsoft funds capacity off balance sheet. Coverage is still huge, but the net cash powerhouse framing is dated. Real fixed commitments now sit against the bet. The upside is just as concrete. If 2/3 of the capital really is tied to contracted demand and the $627 billion backlog converts, today's depressed free cash flow is a coiled spring. As construction moderates, cash could re-expand toward $150 billion and the stock re-rates. So, back to the question, Can the build-out be earned back? On the evidence, Microsoft looks attractive near $385, below a fair value range of roughly $420 to $530. The pessimism reflects uncertainty about capital returns, not deteriorating results. Cash generation is intact, only its destination changed. The single biggest risk to that stance is clean. If Azure growth slows out of the high 30s while Capex and depreciation keep climbing, the build-out is diluting returns rather than compounding them, and the derating is justified. Watch the July 29th print above all else. This is an educational analysis, not investment advice. Every figure comes from public filings and consensus estimates that can change. Do your own research before making any financial decision. If this breakdown helped you think more clearly about Microsoft, subscribe. It genuinely helps the channel. And tell us in the comments which stock we should analyze next. Thank you very much for watching, and we'll see you next time.